Welcome back to the Noob Selling Options channel. Today we are completely ditching those overnight wealth fantasies. Instead, we're diving into a strategic explainer that is focused entirely on sustainable, disciplined options trading. If you've been looking to finally graduate from high-risk gambles into, well, consistent base hit wins, you are in exactly the right place. We're going to look really closely at the anatomy of a high-probability bull-put spread on an absolute AI fortress of a stock, and that's Meta.
Okay, let's quickly run through our roadmap. We'll start with welcoming you to the trade, then we'll break down the legs, run through the bull-put math, explain why we're going so far out in time, discuss our early exit strategy, and finally, wrap up with that high-probability mindset.
All right, let's jump right into Section 1. Welcome to the trade, building a sustainable portfolio.
We are kicking things off by examining a real-world setup that absolutely proves a disciplined approach beats chasing quick bucks every single time. To build long-term wealth, you really have to fundamentally shift your mindset. It's about graduating from making those speculative directional bets, where you just cross your fingers and hope the stock goes exactly where you want, exactly when you want, to a framework of strategic, reliable base hit wins. This explainer is going to show you precisely how we let the actual mechanics of the options market do the heavy lifting for us.
So let's look at the exact multi-leg options trade we placed today, April 30th, 2026. Notice the setup here. We're entering a credit spread on Meta with an expiration date of March 19th, 2027. That is roughly 11 months out from our execution date. I want you to keep that date in mind, because the amount of time we're putting on the clock, that's literally the secret sauce to this entire setup.
Moving on to Section 2, breaking down the legs, income versus protection.
A bull-put spread, which you might also know as a put-credit spread, is essentially two individual positions working together in total harmony. If you mentally tear this ticket right in half, it perfectly illustrates our defined risk. On the income side, our first leg, we sold the 600 put. That gives us the obligation to buy 100 shares of Meta at $600 if it drops below that price by expiration, and for taking on that obligation, we instantly collected a massive premium of $7,283. Now for the protection side, our second leg, we bought the 590 put, paying out $6,793. This is our insurance policy. Without it, our risk on that sold put would be absolutely catastrophic if Meta's stock price somehow went to zero, but by combining them, we strictly cap our downside risk if the stock crashes.
Next up, Section 3, the bull-put math, transparency in numbers.
By executing these two legs simultaneously, we create our credit spread. And honestly, the math here is beautifully simple. The crucial point is our net credit. By collecting $72.83 per share for the put we sold and paying out $67.93 per share for the put we bought, we're left with a net credit of $4.90 per share. Since options contracts deal in blocks of 100 shares, we instantly take in a total of $490 straight into our account.
Now, that initial $490 we just collected, that also happens to be our absolute maximum profit for the entire trade. No complex math required there. We get to keep every single penny of that $490 if Meta simply closes anywhere above $600 on expiration day. If it stays above $600, both options expire totally worthless, our obligations just vanish, and the premium is ours forever.
Of course, we also have to define our maximum risk. Here, it's strictly capped at $510. We figure this out by taking our spread width, which is our $600 short strike minus our $590 long strike, giving us a $10 width, and then subtracting the $490 net credit we already received up front. That leaves us with $5.10 per share, or $510 total at risk. And remember, we only hit this max loss if Meta closes completely below our $590 protection strike at expiration.
And finally, our break-even point sits super comfortably at $595.10. That's just our $600 short strike minus our $4.90 credit. So what does this actually mean for us in practice? Well, it means we've given Meta a massive cushion to drop before we even start losing a single penny on the position.
All right, let's hit Section 4, why so far out? The philosophy of time.
Now, you might be wondering why our expiry date is nearly 11 months away. Well, this is exactly where we separate the gamblers from the investors. We're going for a high probability win here, not quick bucks. We do this by making time our absolute greatest asset through a little mechanism called theta decay. When you sell a credit spread, you're a net seller of extrinsic value. Think of it like an ice cube melting on a hot summer day. Every single day that passes where Meta simply stays above our strikes, the options we sold lose a tiny bit of their time value. That slow, inevitable erosion is constantly, quietly working right in our favor.
By giving this trade an 11-month runway, it acts very much like a leap strategy. We are giving the stock plenty of room to weather any short-term market shocks, earnings misses, or random technical corrections. Having this massive breathing room means we literally do not have to stress about tomorrow's price action at all. We are playing the long game.
Which brings us nicely to Section 5, the early exit strategy, managing for success.
So here's a vital trading secret. Holding all the way to the bitter end exposes you to late-stage volatility, commonly known as gamma risk. We aren't actually waiting until 2027 to close this out. Our plan is textbook risk management. We're aiming to close this position early the moment Meta crosses back above $650. Why? Because as Meta rallies up to $650, it moves further and further away from our $600 short strike. Thanks to shrinking delta, those options become deeply out of the money and their prices just completely collapse. That allows us to buy the spread back early for pennies, secure our capital instantly, and free up our funds months ahead of schedule to deploy into the very next setup.
And that leads us to our final stop, Section 6, high probability mindset, winning consistently.
Everything we've discussed today ties perfectly back to why we set up the trade with such a wide margin of error in the first place. Because our short strike is securely set way down at $600, Meta doesn't need to go on some incredible, unprecedented bull run for us to make our money. Sure, we are waiting for it to recover to a target of $650, but if Meta just trades completely sideways, or goes up, or honestly even drops slightly, this spread will still decay exactly in our favor. Having that kind of directional flexibility inherently creates a high probability setup.
I absolutely love this quote, which really gets to the heart of our core philosophy. Securing reliable, base hit wins by letting time and probability do the heavy lifting is exactly how a sustainable, compounding portfolio is built. Remember, a profit is a profit. Letting the mathematical mechanics of the market work for you rather than against you is how you successfully graduate from being a beginner to becoming a consistently profitable trader.
So my final question for you is this. Are you ready to stop chasing quick bucks and start hitting consistent, high-probability base hits with us? If this explainer helped you understand the real mechanics behind successful, disciplined options trading, please hit that like button, subscribe to the Noob Selling Options channel, and let me know down in the comments what specific ticker or setup we should analyze for our next deep dive. Thanks for hanging out, and I'll catch you next time.